Hello, hello, very good morning to all. I'm Kelvin here again. Welcome to today's Daily Dose of Market Insights. I hope that you'll have a great and restful weekend. Good morning again, and today will be a brand new week, the 9th of December 2024. And right now we are actually at the second week of December, close to about 2.5 weeks more before 2024 ends. So before we start today's Daily Dose of Market Insights, let's have a quick look at the disclaimer first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product, as well as any forecast, prediction, projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. All right, so as usual, before we jump straight into the intraday technical outlook for today's broad-based cross asset classes price movement, let's have a quick recap what has taken shape on last Friday and over the weekend in terms of economic data, relevant news flow, and as well as their impact of their respective broad-based cross asset classes. So let's start with last Friday economic data, which is pretty much important to the state of the US economy, and as well as it could potentially drive future Fed funds monetary policy decision. So last Friday, there's two key economic data on the focus for you guys will be definitely the all important non-farm payroll data, which is representing the state of the US labor market, which is also one of the key economic data that the US Federal Reserve will focus on to determine their future interest rate policy going forward. So last Friday, non-farm payroll data for November came in way above expectation. I would say not way above, maybe it's, I would say above expectation, but for sure, definitely way above that outlier 36K disastrous amount that was actually printed in the previous month of October. So like I stressed, this 36K is an outlier because due to that hurricane impact on the US economy that was hit in the month of late September, early October this year. So in November, it went back to a normalcy amount of 227K, way above expectation of 200K. So if you look at the non-farm payroll data, if you open up the link from here, okay, so the number actually went back to the average level that was seen almost this year. All right, so 227K. So since the start of January, it's about 256K. So it's almost the average level that it went back to normalcy. And most importantly, the unemployment rate remains stable at 4.2%, which was came in within market expectation. So what we could see over here is that it represents a rather healthy level of labor market or a healthy level of hiring in the US labor market, and also coupled with the preliminary figure, that means the flash December figure of the consumer sentiment data as compiled by University of Michigan, which came in slightly above expectation of 74 and above 71.8 that was printed in the prior month of November. So if you look at the trend of the US consumer sentiment as compiled by University of Michigan, the trend is still remains at a robust blip in the US economy. And we know that the US economy is still driven by services activity, and consumer sentiment is one of the leading indicator on the trend of consumer spending, i.e. representing the services activity in the US economy, which consumer spending slash services activity contribute close to 3/4 of US economic growth. So we look at the trend, it's actually gently trending upwards since August this year. So you look at the 5-year trend, is actually maintaining in a very clear uptrending phase. So what it represents over here is that these two sets of key data, consumer spending that represent a leading indication of future retail spending or consumer, okay, let me repeat back again. Consumer sentiment is in the uptrend as represented by the University of Michigan data, as you've seen on your screen over here. It's a leading economic indicator representing future retail spending in the US. So if future retail spending continues to remains robust, that means the services activity in the US will be in a healthy shape as well. And we know that the services sector in the US, or the services activities in the US, contribute to close to 3/4 of US economic growth, coupled with a robust labor market represented by the latest NFP data on Friday, and the unemployment rate, which is still stable at 4.2%. We are now seeing still a Goldilocks economic condition in the US economy. So what does it mean for the US stock market? That means the US stock market still may continues to see healthy earnings growth going forward. And right now the market is totally ignoring the negative impact of future higher interest rate trade tariffs that could potentially lead to tit for tat measures from China and against the rest of the world on US, we call it export to them. So that could be longer term inflationary nature, but markets ignoring that and focusing more on the Goldilocks scenario that could drive earnings growth going forward, and also coupled with next year Trump's generous steep corporate tax cuts as well. Okay, so what you could see over here is that in the performance of the US stock market, the higher beta Nasdaq 100 continues to outperform for the entire week. Last week, on Friday, it added on to the gains, positive 0.92%, the S&P 500 0.25%, and even the small caps benefited as well at 0.54%. Only the Dow Jones Industrial Average underperformed with a slight loss of negative 0.3%. All right, and in terms of the US dollar, so the US dollar managed to actually a kind of a fight back as well on last Friday. Last Friday, it managed to survive at the first support level of 105.48 over here. Okay, it managed to stage a bounce. So also representing that why? Because given the state that the US economy is still in a Goldilocks scenario, there will be a less chance or a lower odds that the Fed will start to engage in deeper interest rate cut cycle in 2025. Okay, so that is all being represented in the the CME Fed Watch 2 as well. Right. So what is this CME Fed Watch 2? For those who actually followed my data on a frequent basis, it actually presents the current state of pricing, interest rate futures pricing, the Fed funds futures pricing, or what market participants gauge in terms of probability in the Fed funds rate. That means, i.e., whether in the next few meetings, how much will the Fed cut or hike or stand back in terms of probability based on the pricing mechanism of the Fed funds futures market. Then the CME Fed Watch 2 compile this probability, all right, based on their model, the CME Fed Watch model. All right, so this is the CME Fed Watch 2, so it's actually up to date with the latest probability of the FOMC rate moves. Okay, it's not really live, but it's slightly about 2 to 3 hours delayed over here. Okay, so let's look at 18th of December. So still no change. 18th of December, still we have a very high odds that the market has really penciled in a 25 basis point rate cut on the next week, 18th of December. Okay, bringing down the Fed funds rate to 4.25% to 4.5%. Okay, so that is more or less has already been priced in. But what's interesting that, or what's important that we need to know after last Friday robust data coming out from the labor market and as well as coming up from the consumer sentiment, a leading economic metrics that could impact future consumer spending in the US is the future market pricing mechanism for the next few Fed funds meeting down the road next year. That means what you want to interested to see in January all the way up to December next year, what the market pricing is like to be by looking at the aggregated tab. Right. So in this aggregated tab, so we are here, the next one, 18th of December. All right, 4.25% to 4.5%. So that is remains almost unchanged. All right, unchanged over here. Then thereafter, what we could see over here is that on the 12th, 29th of January, market is expecting it to remains the same at 4.25% to 4.5% potentially after the next cut in next week, so unchanged, then only potentially that we may start to see a interest rate cut again, either in the March or May meeting. March or May meeting. That means March or May meeting over here, we have 80% chance. The May meeting, that means 19th of March, 80% chance that it may go down lower at 4% to 4.25%. In the 7th of May FOMC meeting next year, also same chance that it may go down to 4% to 4.25%. That means, i.e., the next interest rate cut after next week cut potentially may come in is only in either March or May next year FOMC meeting. That means either the 19th of March or 7th of May. All right, other than then thereafter, the market may do another cut again, either in June, July, or September, but higher odds of them are centered in July, okay, at 93%. All right, then thereafter, the market will start to remain stable. Expectation of the Fed funds rate to be at 3.75% to 4%. So what we could see over here is what the market is looking at given the state of a Goldilocks economic condition in the US after that robust reading, NFP reading, and that rather a continuum of uptrend of consumer sentiment as compiled by the University of Michigan survey data. The US economy is not falling off the cliff yet, and potentially we could start to see inflationary pressure coming back into the US economy due to Trump, we call it aggressive trade tariffs plan, if he will actually fulfill his promises. That lead to what I call a rather shallow interest rate cut cycle in 2025. That means potentially only two interest rate cut of 25 basis point each in 2025 to bring down to 3.75% to 4%. And that this chance to bring it down lower to three interest rate cut in 2025 on the 12th December meeting, that means the 10th of December meeting, is only at 56% chance, not really that high. All right, so market is now still looking at only potentially a rather shallow interest rate cut cycle next year. All right, so with that pertaining to pay Goldilocks scenario, US economy, still very strong US stock market. All right, but because of this shallow interest rate cut cycle, it lead to a rather firm US dollar performance on support. That means the US dollar didn't fall on Friday, rather maintaining on support on last Friday. And potentially we also could see a longer term dollar strength major uptrend that could potentially still remains intact for 2025. All right, so that is the impact on last Friday key US economic data on the major US stock indices and on the FX market. All right, from here, that one thing I want to share with you over here is that potentially this morning we have a rather weak weak China inflation data. Pardon me. All right, so like I repeat, for this morning we have a key data that is out from China, which is the inflationary trend of China. So let's take a look at it over here. All right. So over here, what we could see is that inflation rate. So today, China released their inflation rate at 9:30 a.m. and this inflation rate year on year still remains rather weak at 0.2% year on year, way below expectation of 0.5%, and also below previous month reading, October month reading of 0.3%. And the PPI, which is the factory gate data, that means raw materials input, where businesses consume, also remains lackluster as well. All right. So previously, it was at negative 2.9%. So slightly going above at 2.5%, but still, if you look at the trend, yes, a slight improvement, but not really that great. All right, it's still okay. You look at the 5-year trend. All right, a slight improvement. Okay, but it's still hovering below July and August trend of negative 2.8%, going up negative 2.5%, still below negative 1.8%. So the trend hasn't really turned up to the upside yet. All right. And because of this trend hasn't really turned up to the upside, it actually impacted the consumer inflation data. So if you look at the consumer inflation rate trend in China, continue to be rather depressed on the downside. Okay, by looking at the trend. Okay, this inflation rate. Okay, let's go to the 5-year trend. All right, so because this is, let's look at the graph. Okay, it continues to trend downwards, a lower high. All right, so what we could see in the inflationary trend in China continues to be at risk of a deflationary risk spiral. All right, a deflationary risk spiral. So that actually also impacted the Aussie dollar as well. All right, so the Aussie dollar also continues to remain lackluster because of its close economic trade relationship with China. All right, so later I'll share with you on the Australia dollar against the USD. What is the key technical outlook to be? And right now they are in a rather vulnerable state. All right, from here from a technical perspective. So later I'll touch on the intraday technical outlook on the Aussie dollar. All right. So with that, then one more data I want to share with you all is over the weekend is this fall of a Syria current government. So Assad has already more or less regime has already ended in Syria over here. So apparently right now, due to this fact over here is that it's not as serious as the Israel-Gaza conflict, but it could potentially lead to some uncertainty that could start to see a bit of a geopolitical risk premium rising again in the Middle East region, and that could also potentially kind of at least on the intraday basis support the oil price. So we know that oil price has been inching down lower and lower due to number one, OPEC Plus do not want to actually start reducing their supply as soon as reducing their what you call it, starting their supply high production. That means they don't want to increase their supply. All right, so they're pushing it down down the can into March or April this year after last week OPEC Plus meeting. And also on the other hand, we start to see this, yes, even though they didn't want to increase their supply, but external factor due to rather weak China demand and also potentially the rest of the world as well. In Europe, it also remains weak in terms of their PMI data. That also causes the oil price to actually unable to see that bullish reversal. And with today's this potential current geopolitical risk premium that could raise slightly higher in the Middle East, we may see a bit of intraday rebound in oil price. But from my perspective, there's still no major bullish basing formation in oil price. So later I'll share with you on the technical chart. All right. So if you look at based on this slightly uptick in geopolitical risk premium in the Middle East due to the fall of the Syrian current regime. At the moment, we see oil price up by 0.3% as we are speaking. Okay, let me share with you the data of oil price over here. Yeah, oil price is up 0.5%, okay, to 0.4%. All right, at this point in time while we are speaking. All right, okay. So with that, gold price is also up slightly as well, 0.5%. So later I'll share with you the technical chart of gold is still remains stuck in the sideways range. So gold still can't break above that key 2666 short-term pivotal resistance that we highlighted on last Friday. Okay, later I'll touch more on that. All right, okay. So these are the key data, news flow, and how they impact their respective broad-based cross asset classes. All right. So with that, now let me now jump straight into the intraday technical outlook. All right, on the FX market first, as usual. So let me expand my screen so that you guys could have a better view on the trend and the key levels. All right. So let us start with the FX market. So starting with the euro dollar. So over here, the euro dollar continues to actually unable to break above the 1.06 short-term pivotal resistance that we highlighted. All right, a bit of whipsaw that due to the NFP data release, then before tumbling down lower and hit the first support level 1.0530, which is the 20-day moving average, before trading sideways in the entire US session on last Friday. So what you could see over here is that the daily RSI also broke below a parallel trend line, parallel former ascending trend line support level. All right, and also now hovering below the 50 level mark, indicating the lack of upside momentum on the euro dollar. So still no change, using 1.06 short-term pivotal resistance as my resistance level, key intraday resistance level, to maintain that intraday bearish bias on the euro dollar. A breakdown below 1.0530 for today potentially open up scope for a higher probability of euro dollar weakness, exposing the next near-term support level to watch on the intraday basis will be at 1.0460. Okay, only an hourly close today above 1.06 figure level will invalidate today's intraday bearish bias to see a continuation of the mean reversion rebound scenario extending to the upside, exposing the next near-term resistance level to watch thereafter at 1.0660, 1.0680. Okay, so that's for the euro dollar. Intraday technical outlook, still maintaining that intraday bearish bias. Key resistance level to watch 1.06 figure. Potential downside trigger level 1.0530. Below it exposes 1.0460. Hourly RSI technical configuration is rather weak, supporting this intraday bearish bias. All right, so now with that, let us now looking at its cousin, which is the sterling dollar. So the sterling dollar is rather mixed over here. So to me, it's rather mixed. It's still holding on very clearly above this minor ascending trend line, the 20-day moving average. Hourly RSI is weak as well, still below that former breakdown parallel ascending trend line resistance, now turns into a pullback. Former ascending trend line support now turns into a pullback resistance, this dotted red line here, and the RSI is still below the 50-day moving average and below the 50-day level, pardon me, and there's a bearish reaction of it on today's morning Asia session. All right, so with that, because of last Friday rather strong push over here, okay, there's a strong push up, then before hovering again downwards. So I will have a neutrality stance for today on the sterling dollar, because yesterday last Friday push out also got rejected at the key 200-day moving average. So on an intraday basis, I'll rather stay neutral for today because of last Friday's stronger push up. 1.2810 upper limit, lower limit of the neutrality range 1.2690. So only a very clear breakdown of hourly close below 1.2690 potentially see a higher chance or higher probability of the bearish bias coming back into the sterling dollar, exposing the next near-term support in first step on the intraday basis at 1.2610. If it's able to break below 1.2610 today, it may expose 1.2510 next. All right, so stay neutral for now first, 1.2810, 1.2690. Right, now with that, let us focus our attention to the Aussie dollar. Okay, so I'll share with you why Aussie dollar is a very critical juncture right now. Like I say, today is actually managed to this last Friday price action today continues to remain weak, and now is testing the lower limit of this key major pivotal support zone at 63.60 figure, at 63.60 level. Why 63.60 level is important? Because it's the lower limit of this major ascending trend line that I drew from the low of 13th of October 2023, and 63.60 managed to survive three key outcome. On the 10th of November, sell off, managed to stage a bounce, and this bounce, it lasts for a couple of weeks. On 19th of April, it managed to survive and stage a rebound that lasted a couple of weeks. And on 5th of August, it's also survived and managed to stage a rebound in a couple of weeks. And right now, it's trying to test this level again at 63.60. But if you look, this is the daily time frame. If you look at the weekly chart last week on how the price action actually concluded last week, is a bearish Marubozu candlestick. And this Marubozu long black candlestick rejected at the 20-day moving average. Okay, so that is not a very good omen on the Aussie dollar, despite it's coming very close to a key support level at 63.60, where previously it managed to survive and stage a multi-week bounce off it level in the previous 3 instances that I shared with you earlier on. And the weekly RSI is also doesn't look quite good as well, because price action on the weekly RSI according to shape lower low, lower high, hasn't hit the weekly oversold region yet. All right, so this represent a rather we call it significant probability that it may not survive the 63.60 this time round. And if it doesn't survive the 63.60, because this is a lower limit of a major pivotal support zone on the Aussie dollar, it could trigger off a multi-week to multi-month potential decline. Why? Because it has been consolidating for close to a year since 13th of October 2023 low. So something to pay attention to on the Aussie dollar. All right, so for now, for today's intraday level to watch. Okay, so this is a bigger picture that I'll show you on the Aussie dollar. So for today, intraday level to watch on the Aussie dollar will be using a Titan key short-term pivotal resistance for today at 64.50, which is the lower limit of this minor descending channel that I drew from the minor swing high of 2nd of December, also confluence with the rejection on 5th of December, and on Friday, uh, minor swing high during the Asia session, also very close to the split up on the NFP data release, right, before it tumbled downwards. Okay, so 64.50 short-term pivotal resistance level to watch. Potentially it may do a bit of bounce during the during the European session at 64.20, but still maintaining the intraday bearish bias. First support level will be for sure 63.60 level, which is the major lower limit of the major pivotal support zone that highlighted on the daily chart just a while ago. But however, on the intraday basis, it's managed to actually pierce down below 63.60. The next support level will be 63 figure 62.85, which is the 2 times Fibo extension level that I drew from the high of 25th of November, and 63.60, 63 figure slash 62.85 also confluence with this 13th of October swing low area over here of last year. Right, this level here very clear. Okay, last year October swing low area. Okay, now back to this chart again. But however, if price action managed to surpass above 64.50 for today with an hourly close above it, then the Aussie dollar may survive today for a minor mean reversion rebound, exposing 65.10 and potentially even 65.45 next. Okay, so that's for the Aussie dollar. Now, turning our attention will be the dollar yen. So dollar yen, we don't see any clear dollar strength coming back into the picture. Why? Because dollar yen is very strangely is being used as a risk on, risk off proxy as well. All right. So given that the fact that we may see geopolitical risk premium kind of increase, and also due to the Korean current political instability right now in South Korea that is still lingering around the marketplace, that's why it kept the dollar yen strength from moving up higher. And do not forget over here is that next week we do have Big Bank of Japan, and Bank of Japan based on current Japanese inflation data, and also there's this remark that being made by Bank of Japan governor last week in as reported by the Nikkei Asia media, that he did mention that now is the time to potentially further normalize Japanese monetary policy. That means for Japan is different from the rest of the world. They have been in very low interest rate for more than decades plus, I would say, and it's only this year that Bank of Japan starts to hike interest rate gradually. So there could be hint or further guidance that this firmer gradual interest rate hike in Japan may come in next week BOJ meeting. Right. So with that, we start to see this dollar yen rate to remains rather okay. In fact, BOJ meeting is, let me do a quick check. Okay, let me do a quick check over here. BOJ meeting, the exact date of BOJ meeting. It should be next week. Okay, oops. Let me do a quick check for you guys. That's strange. Yes, yeah. So it's on next Thursday, okay, 19th of December. Okay, 19th of December. So that's BOJ meeting next Thursday. All right, over here. So back to the dollar yen chart again. Okay, so dollar yen chart, no change. I don't put it so tight at 150 70. 150. I don't put it so tight 150 70. Slightly higher 150 120, which is the 50-day moving average, also acting as a resistance. So this will still remains my key short-term pivotal resistance for the today on the intraday basis. 15120. Maintain that intraday bearish bias on the dollar yen. Next support level to watch will be at 14885. A breakdown below 14885 may expose 14725 next. Okay, only an hourly close above 15120 will invalidate today's intraday bearish bias on the dollar yen to start to see the extension of the mean reversion rebound, or the rebound taking shape again at 15190 slash 15215. Above this level exposes 15330 slash 15370. Right, so that's for the dollar yen. So that also conclude the intraday technical outlook for today on the intraday basis and the key levels to watch on the FX market. So now turning our attention now will be the major stock indices, starting with Hong Kong over here. So for the Hong Kong 33 over here is that because of this rather lackluster inflation data that's out from China this morning, there was a minor sell-off right now on Hong Kong 33, but still holding above our short-term pivotal support level at 19,570. And the recent bounce that was seen on Friday is due to this upcoming economic work conference that's going to be held this week in China among China top policy makers. All right, and this is a closed door session. They will not report live what they are being discussed. A closed door session, and this week the timing is the date is only tentative. All right, tentative. All right, so it's likely a 2 to 3 day. Okay, let me share with you. Okay, it's at least 2 to 3 days. Okay, kicking off from this Wednesday. Right, so it's only towards the end of week, so we got to keep a lookout on either Thursday or Friday. Some of the local Chinese press will start to report some hints of what is being discussed in this economic work conference out from China. And why this economic work conference is important, because they will set the target, the economic target, GDP figure, inflation rate, and what they want to achieve in 2026. And this target will only that means officially announced in China 2 session. They call it the 二会, National Congress. It's a 2 day session. Very likely will be in the first week of March next year. So only the official, we call it target, will only be announced during this National Congress in early March next year. But in this week economic conference, they will set sign on the target already. So do keep a close watch. I'll also be keeping a close watch on the media, local media, on Thursday and Friday this week to see is there any kind of source news leak that reported what this China top policymaker has for China economy. And because of that this ongoing lackluster economic data out from China, and with the risk of higher trade tariffs in the incoming Trump administration that going to be hit on China export to US, people are speculating that the China top policymaker have no choice but to engage with higher physical stimulus, or much more forceful stimulus, rather than the piecemeal one that they keep on having in the last few meetings or the last few relevant policy announcement. So with that, let us straight go jump to the Hong Kong 33. So still no change. The Hong Kong 33 continues to trade above the 20-day moving average and still trade above this minor ascending trend line that is still in place since 26th of November. So still using 19,570 as my short-term pivotal support level. We do have an intraday bullish bias again. But first resistance level to watch is only at 20,150. All right, this is the first resistance level to watch, 20,150. Only a breakout above 20,150 may expose 20,490. However, if price action starts to break down below 19,570 with hourly close below it, then we may see another round of choppy downside movement on the Hong Kong 33 to revisit this minor range support level at 19,080 that managed to survive since 22nd of November. So that's for the Hong Kong 33. Now, turning our attention will be the Japan 225, i.e. the Nikkei 225. So continues to trade in a sideways range. So still no change, still maintaining that neutrality stance since last Friday. 39,380 got rejected on today's Asia opening session. Hit can't actually break through and starts to trade down lower, but still holding above the 20 and the 50-day moving average, and as well as this minor ascending trend line since 28th of November. So still remains a neutrality stance for today. 39,380 upper limit, lower limit 38,830 / 38,670. And bearing in mind, from a medium term perspective, it still continues to be trapped in this complex sideways range configuration since the low of 27th of September this year. Okay, so that's for the Nikkei 225, i.e. the Japan 225. Now, turning our attention will be the European stock indices, which is the German 30 or the German DAX. So the German DAX continues to actually shape a bit up on last Friday, but managed to stay below the short-term pivotal resistance at 20,470, which is also now at the upper limit of this minor ascending channel, and also the upper limit of this major ascending channel since the low is the daily chart since the low that is in place of 30th of September 2 years ago, all right, 2022. So with this major we call it ascending channel upper boundary, okay, that is right now trying to actually hover below it, and coupled with the hourly RSI that continues to shape lower high and a bearish divergence. Right now there's a series of lower high already here. Okay, from here, this high lower than this high, and right now there's another lower high. So a rather lackluster short-term hourly RSI momentum condition, indicating a lack of bullish momentum on the hourly basis. We still maintain that intraday bearish buyers looking for at least a kind of a minor pullback that may take shape on the German 30 within its short to medium term uptrend that is still intact. All right, so we have for today, the only difference is I'll have a downside trigger level at 20,310. A breakdown below 20,310 may expose the next near term support level at 20,155, followed by 20,010. All right, only an hourly close above 20,470 for today will invalidate today's intraday bearish bias to see the continuation of this impulsive up move sequence, exposing the next near-term support level at 20,650 next. Okay, so that's for the German 30 or the German DAX. Okay, now turning our attention will be the major US stock indices, starting with the Wall Street 30. So the Wall Street 30 continues to actually underperform last week and last Friday, but it still managed to hold above the 20-day moving average and the short-term pivotal support level at 44,520. So still no change, still using 44,520 short-term pivotal support level. And given that the hourly RSI has really hit the oversold level, and what we could see on the hourly RSI, so the hourly RSI has started to shape a bullish divergence on last Friday. All right, so let me put it over here. This is the lower higher low, whilst price actions trade lower low, okay, on last Friday. So with that, 44,520 short-term pivotal support on the US Wall Street 30, i.e. the Dow Jones Industrial Average, still maintaining that intraday bullish bias. First resistance level to watch for today, 44,870, followed by the current all-time high area at 45,070. Only an hourly close and a push down below 44,520 invalidate today's intraday bullish bias to kickstart a much more deeper minor corrective decline pullback sequence to expose the next near-term support zone at 43,980 / 43,807. Now, turning our attention will be the Nasdaq 100 continues to print fresh all-time high on last Friday and almost hit the resistance level that we highlighted as well, 21,650. All right, so with the hourly RSI now hitting the overbought level on last Friday, and now during the Asia session, it starts to retrace down from the overbought level, indicating that there could be a chance of a minor pullback heading into the European session and maybe at the start of the New York session or the US session for today. First support level to watch will be at 21,506. Key pivotal support level, I don't put it so tight, at 21,506 will be at last Friday intraday low, where we start to shape that bullish push up, expose NFP data release at 21,400 next. All right, so 21,400 will be the Titan short-term pivotal support level to watch, below the 21,506 potential minor pullback level that it may reach during the European session and maybe at the start of the US session. So as long as it didn't break below 21,400, I will maintain that intraday bullish bias on the Nasdaq 100. After 21,650, the next resistance level to watch will be at 21,770, 1.618 Fibo extension from the low of 19th of November, and as well as potentially the upper boundary of this minor ascending channel that is still evolving within it since the low of 28th of November 2024 low. However, only a hourly push down with a close below, with hourly a push down and hourly close below 21,400 short-term pivotal support level may invalidate today's intraday bearish bias to kickstart a much more deeper minor corrective pullback scenario unfolding on the Nasdaq 100 to expose the next support level at 21,220, which is the lower limit of this minor ascending channel that I drew from the low of 28th of November. A breakdown below it exposes 21,100 next. Right, so that's for the Nikkei 225. No, that's for the Nasdaq 100. Pardon me. Okay, so that's for the Nasdaq 100. Okay, US Nasdaq 100. Okay, we are tongue twisting for today. All right, so with that, that sum up today's intraday technical outlook on the major stock indices. So now let us focus our attention to the commodities market over here, starting with gold XAU/USD. So for gold XAU/USD on last Friday, it hit the lower limit of 2,622 before trading sideways again. So still no change. It's still going to be compressed within this sideways range configuration since the low of 26th of November. Okay, upper limit, which is the 50-day moving average, that can't break out since it tests on it on 29th of November. So 2066 will be still the short-term pivotal resistance level to watch, still maintaining that intraday bearish bias within this tight sideways range configuration. Sideways range configuration support level, the two level on the intraday basis will be 2,622 followed by 2,600 slash 2,590. So only a breakdown below 2,590 will trigger off a potential start of another, we call it a multi-day corrective decline sequence in the first step, exposing the next support level to watch. Okay, maybe over here, this zone here. Okay, at 2,574 slash 2,560. Okay, let me put it in writing so that you guys could see much clearer. 2,574 slash 2,560. Okay, so this is the next support level to watch if we start to stage a bearish breakdown between this minor sideways range configuration, where the lower limit or the support level is at the 2,590 level. All right. So however, if it starts to do a hourly close and a breakout above 2,066, then what we could see now is much more a recovery scenario coming back into gold XAU/USD. Near-term resistance level to watch on the intraday basis will be at 2,689, followed by 2,728 slash 2,715 next. All right, so that's for gold. Still maintaining that intraday bearish bias as it continues to hover within this minor sideways range configuration, holding below that 2,066 short-term pivotal resistance level that we have on last Friday, also confluence with the 50-day moving average. But however, near-term support level to watch, because I still compressed within this range configuration, still remains unchanged. 2,062, 2,622, a breakdown below 2,622 exposes 2,600 slash 2,590. So that's for gold, XAU/USD. And lastly, let's touch on West Texas crude oil over here. So West Texas crude oil, let me go to the daily time frame chart again. Why this is a crucial level right now? Because it's now hovering at the major range support zone at 67.55/65.70 over here. So 65.70 is the lower limit. Why this level is important? Because it's actually the lower limit of this major descending triangle range configuration that was still in place, or that is still in place since the low of 20th of March 2023. All right, very important. So if it starts to have a hourly close below 65.70 and a daily close below it as well, that means a daily close versus daily chart, a daily clear close below 65.70, then potentially we could unleash a major bearish breakdown on the West Texas crude oil. That means could kickstart a kind of a multi-week to multi-month impulsive downward sequence. All right. So on the intraday basis, because we know that the price action don't on a highly liquid tradable instrument don't go vertical up, vertical down. They oscillate within trends. So on a daily basis, what we could see over here is that after hitting our support level on last Friday at 67.10, that we have a downside bearish bias. The hourly RSI now starts to have a bullish divergence. All right, on West Texas crude oil. Okay, there's a bullish divergence here. Higher low at the oversold level, and now it really exit from the oversold level. Potentially, there could be a minor bounce taking shape. And also with this bullish divergence increases the chance of that minor bounce. So using 67.10 as my short-term pivotal support level for today, potentially see there could be a minor bounce scenario unfolding, but not a major basing formation yet, because there's no clear sign of a major basing formation as seen on the daily chart. So 67.10 short-term pivotal support level flip to a intraday bullish bias for this minor bounce scenario that could potentially play out. Two key resistance level to watch on the intraday basis for today will be 68.20 followed by 69.30. So 69.30 is the 20-day moving average, confluencing as well as a resistance level. Only a hourly close below 69.30 may see a much more extensive minor corrective rebound scenario for today, exposing the next near-term resistance level at 70.80, which confluence with the 50-day moving average, I think as a resistance level as well. Only a push down and the hourly close below 67.10 will invalidate today's intraday bullish bias for that minor bounce scenario to play out, to continue see the impulsive down move to test the lower limit of that major range support zone that highlighted earlier on the daily time frame, which is at 65.70. All right, so that's also sum up the intraday technical outlook on all the broad-based cross asset classes that I shared with you all for today. So before we go, let's have a quick look at the economic calendar. What are the key data to look out for today? All right, other key data to look out for today. Okay, so let's put this week back again. Let's go to OANDA. Okay, minute, it's hang right now. Okay, so for today, during the European session, there is no key data to watch as well, except we have Japan sentiment data that is out at 1 p.m. Singapore time. They call it the Eco Watchers Survey Outlook. So it's a business sentiment data, something to take note of. And after that, we do have a rather quiet US session, not much of a US session. And for tomorrow morning, we do have this NAB business confidence data out at November, for the month of November, pardon me, for Australia. And at 11 a.m., we have China trade data, balance of trade data out at 11 a.m. And most important for tomorrow highlight will be 11:30 a.m. RBA meeting. As we know that why RBA meeting is important, because it could shape the movement of the Aussie dollar, and the Aussie dollar is now coming very close to a major support level at the 63. Let me go back to the Aussie dollar chart again to give you all that highlight. Is at this key lower limit of this major pivotal support zone at 63.60. All right, over here. Okay, so back to the economic calendar. Okay, so RBA will be at 11:30 a.m. while we are speaking, okay, in tomorrow daily dose, and followed by the RBA press conference, which is important as well, because in the last 6 to 8 meetings, RBA has not even cut interest rate, despite there is some weakness in the Australia economy, and after the rather weak expected Q3 GDP data out from Australia last week, there could be a change of tonality in RBA governor's very staunch hawkish rhetoric. So he may switch to a much more dovish stance. All right, over here, market is not expecting any interest rate to cut to come tomorrow. All right, in RBA, but as long as if there could be a switch of a dovish stances in the RBA governor press conference, it could potentially see significant movement on the Aussie dollar. All right, so something to take note of 12:30 p.m. So we'll highlight more of it in tomorrow's daily dose. All right, so that sum up today's daily dose of market insights for today. I'm Kelvin here signing off, wishing you all a great day ahead, and we shall speak again tomorrow. Thank you.